Welcome, everyone, to another edition of the Tony Sirianni podcast. I am thrilled to have my friend Alex Shahidi, who is the co-CIO and managing partner of Evoke Advisors. You may recognize him from this. So we're glad to have you on the cover. And this is a great achievement because it was, you know, for you being one of the top RIAs in the United States. So congratulations on that.
I appreciate it. Thanks for having me.
Well, glad to have you here. So I know it's morning out there, so we'll get you going because he's in California. Look, I think a lot of advisors would love to hear sort of your story. You started at a wirehouse, so tell us a little bit about that and what how many years ago did you make this decision to move to RIA and what was that like?
I'd love to share that. I think I traveled a slightly different path from most people. So it might be something they haven't heard before. So when I came in, I came right out of school. I came out of law school, came to Merrill Lynch in the late 90s during the internet boom,
Yep.
and came in as a financial advisor. And I was excited. I'm going to come in, I'm going to give people financial advice. And what I learned very quickly is it's more of a sales industry than it is an investment advisory industry. So at first I was a little disappointed, but then I realized you have a lot of flexibility at big firms like that, just like you do in an RIA to do what you think is best for your clients. So rather than, and I'm not a salesperson at all. So that's why I was disappointed. I'm an investment person. I'm an analyst. I need to figure out how to do things. And I tell people about that. So I started reading and I started studying because I needed to become an expert in this industry. So I went and got the CFA, the CFP, the CIMA, all the designations. I just taken the bar exam. So those exams weren't that challenging compared to the 18-hour.
I know, you're in the mode of testing when you're
That's
doing
right.
the law exam. Yeah.
That's
Well,
right.
I
Yeah.
went to law school too, Al. I'm not proud of it. I don't tell a lot of people, but I did.
Yeah,
So
I never practiced and I never regretted it. But I feel like you're either in study mode or in your work mode.
yeah.
And I knew while I was in study mode, I should just keep studying. So I did all that, and I never really marketed because that's just not who I am. And I just got in front of people, and when I explained things, they said, that makes more sense than what I've heard elsewhere. And so my close rate was higher, and I kind of moved up the ranks with that approach rather than trying to sell. And what I found is because most people are salespeople, I'm not saying it's a bad thing. That's just how they're built. And it's understandable because if you can't sell, you can't really survive in this industry. Right? You got to get clients. You could be the best investor, but if you have no clients, you have no business. So I found that I've navigated towards people who are more like me, who are more investment focused.
Always the case. If you find an advisor who's a jerk, his clients are jerks. If you find a really nice guy advisor, his clients are all nice people because you end up dealing with people that you could spend the afternoon talking about stocks and bonds. So I think there's something really to that. So that you're the non-salesperson sales guy who brought in billions of dollars, and probably because other people a lot of money. They don't want to be sold. They want somebody to explain to them what's going on.
Right. Yeah. And so I just started working with more people that I thought were more like me, both clients and partners. And so I was at Merrill Lynch for 15 years, was managing over $10 billion while I was there. And in 2014, it was time for me to leave and start my own firm. So I left.
And that's a big business to move.
Yeah.
$10 billion. That's a lot. That's a lot going on. A lot of moving parts there. And I'm assuming you have a team, right? So over time, you must have built up a team, or are you the
Well, it was me and one other guy that I brought with
$10
me.
billion? That's a
Yeah.
big.
Yeah, but it's not that many clients, right? So I think it was
No, I
probably
get it. So I
30 or
assume
40
it's not
clients.
many clients. Yeah, it's not many clients. And number two is, different kind of service model. It's you're talking really investments with people, all the
That's
time.
right.
Just worried about sending birthday cards, right?
That's right. Yeah. The other thing that I did was unique is I didn't custody most of my assets when I was at Merrill Lynch with the firm. They were custodied outside. And so when I left, the call was relatively easy. It's, I left. And if you want to work with me, you cancel your consulting contract there, you sign a new one here, and basically we're done.
Yeah.
So it was the transition actually wasn't that difficult because it's just the unique way of setting it up. So managed my own firm for 6 years and then merged it with my good friends from Evoke, who I had known for 20 plus years. We were in the same office at Merrill Lynch, and we've been talking about partnering for 13 years. Philosophically aligned. I feel like they're kind of like me in terms of being investments first
right.
versus sales. And so we put our group together. So now we're about 23 billion, about 60
Okay.
employees.
Wow, that's fantastic. Well, then, you get some scale. I mean, even though you were
Yeah,
doing this, kind of as a one-man band at Merrill, I'm assuming you see some of the benefits of scale today.
for sure. Yeah. And one of the things that was challenging for me is whenever I asked people around me, about an idea that I had and I wanted feedback, everybody said, "Oh, that's the best idea I've ever heard." That doesn't help me. I want people who challenge me and say, "That's a stupid idea. And let me tell you why."
Right.
And what I found is when you find people that are like that, it actually helps you grow. And so I've constantly been seeking partners who provide constructive feedback, are smart in areas that I'm not smart, or good in areas that I'm
Right.
not good at. And I think that's how 1+1 = 3 when you form these partnerships.
I find it so, I mean, we're doing this event I told you about in September, but it's for, billion-dollar advisors with big teams because it's lonely. I mean, you're sitting there and you want feedback, even though you're not a sales guy, you're still a creature that wants to, kind of mix it up with people and
Yeah,
talk about the things you're passionate about, like investing, or this is how I want to do it. And I find a lot of big advisors end up isolated, because it's a hierarchical structure, right? So
yeah,
it's top down, and they feel like they don't have anybody to bounce anything off of.
that's right. Yeah, and if I think about what our mission is as an advisor, it's to constantly improve the portfolios that we manage for our clients, and that's a lifelong process. You never reach the finish line, but it's the journey of constantly improving. And to get there, you have to be an independent thinker. You have to have a different perspective. You're not necessarily going to follow the herd, but in some cases, maybe it makes sense. In other cases, it doesn't. And so you need independent insight that will help you make those improvements. So you got to find really smart people that are independent thinkers that are not just doing what everybody else does for good
Yeah.
reason.
This is it just strikes me as a journey of making a virtue out of necessity. I mean, you were not a sales guy, but you turned it into a virtue, right? You did
Yeah.
eventually with a partnership. I mean, and by the way, that's how we built AdvisorHub. So it's the same thing. You work with what you got.
Yeah. Yeah, yeah. So I think that's basically what I'm still on that journey. I'm looking for people who are interested in a different perspective because they think it's better. And to make improvements, you need to surround yourself with people who are willing to challenge what you're saying. And it's just hard to find.
Hard to find, and then scale presents itself in a different way today. I mean, obviously you were growing during the pandemic. We've had a technological revolution since you stared in
Mhm.
the 90s, right? We're doing things like this you can do with clients now, and especially I'm imagining with the $100 million 9-figure clients, right? They don't need you to come carry a bag to their office. Are you doing a lot of Zoom with these guys, right? They're on a boat or wherever they are.
Yeah, and I think it's really interesting because most of the people we deal with, and ourselves included, have our biggest constraint is time.
Yeah.
And so now you can have a meeting like this, and it's maybe 80% as effective as an in-person, but it's extremely more efficient. There's less travel time, you're sitting in traffic, et cetera, and you can do more of these.
Yeah.
And so you're balancing between the efficiency and the effectiveness. And so what ends up happening is the most important meetings you do in person and everything else you do virtually. And to me, that seems like a good balance. And so our clients are very comfortable with that.
Yeah, and I think it's the folks that have embraced those things, the future technology that are gonna win here. How are you applying some of this, technology that advanced? I think really took a leap during the pandemic, and of course, when you interestingly, not to backtrack a question, but when you leave the wirehouse, when you're at a wirehouse, you feel like this is the only place that can do this. And then when you leave, you see the world of technology has grown. And look, when I started at Merrill too, they own technology. I mean, they had their own technology, and that was the only way to
Mhm.
get it and everything else. But when you go RIA, kind of the blinders come off, don't they? And you sort of see, my goodness, there's an awful lot of technology here.
Yeah. Yeah. I mean, if you think about our objective is to do the best we can for our clients. So that's not just in the portfolio, but in the way we set up our business, the technology we use, how efficient we run it, the services we provide the clients, the data points, et cetera. So technology fuels a lot of that.
Yeah.
And when you're at a big firm like that, you're basically going to get whatever technology that group decides to implement. A lot of times it's because it's the most cost efficient rather than
Cost
the
efficient,
best
or
technology.
they have to manage, these big large wirehouses often have to manage to the lowest common denominator.
For
So they're,
sure.
and so everyone has to kind of get into this funnel, even though it doesn't really fit, your business.
That's
Um,
right.
so using the technology and the scale, let's talk about the investment side now. So how has that helped you sort of, we talked a little bit about it, but it's almost like it's an embarrassment of riches with the research that we have available to us. How do you manage what's out there? Because I mean, look, there's a benefit to the big firms doing a lot of thinking for me. So I'm just going to go ahead
Yeah.
and do this versus now you got this. It's a pretty big world out there.
Yeah. I mean, for me, the transition was easy because even when I was at Merrill, I didn't really use the research
Okay.
because I viewed myself as, I always called myself an RIA trapped in a brokerage firm, where I'm doing what I think is best for the clients. I try to be independent and objective, and I'm not going to use the firm's resources if I think there's better ones, including custody and research. So I've always sought the best input that I could to build my investment thesis. So that's continued as an RIA, basically using the same research. I'm out there talking to the smartest investment managers, looking at their research, reading basically whatever I can, filtering out what I think is most insightful. If you think about it, the vast majority of research is basically saying the near future is going to look like the recent past. So that's, and what's interesting is that's right most of the time, but the big inflection points is what really matters. And so I'm constantly trying to find who is really good at identifying the next big inflection point. What's their track record of making these calls? And then have a kind of an advisory board, like a virtual advisory board of that insights, informing my thought process, and then using that to make investment decisions.
So knowing that, right, and seeing kind of where we are today, this has been, look, since not only has our business been changing and in flux, but boy, the markets have had a lot. I mean, we've ended up all right, but COVID, we had a big, the crash.
Yeah.
There are pressures on the market today that weren't there when you left or when you started your own RIA. What are you seeing in terms of how some of these really novel pressures are sort of acting out on the space now?
Yeah, it's interesting when you look at history. It seems like a lot of data points, but there really aren't that many because you have to think of it as different types of environments. So to me, it's not a surprise that we're seeing a lot of things we haven't seen before, and it's because we just haven't seen that much. So if you kind of zoom into what's going on now, you had COVID, you mentioned, that was kind of once in 100-year type of storm. Then you had this policy response that was just massive and unprecedented in size, and that was probably too much for too long. Now you have the highest inflation in 40 years, then the fastest tightening in response to that high inflation in 40 plus years. And that caused all assets to fall basically because they all compete with cash. Cash goes from 0 to 5.5, and all of a sudden you can, cash becomes an attractive investment. So where does that lead us? I think it's either there's too much tightening, and it's hard to know because there's a lag effect. If there's too much tightening, you get a bad recession, and which may be hard to reverse. If there's not enough tightening, then rates may stay higher for longer, inflation may stay higher for longer, and anything in between those. That's a wide range of potential outcomes.
It is, and it's weird because it's again, think back before you got in the business, but you were still aware at the time, like a Paul Volcker kind of thing.
Mm-hmm.
I mean, no one knew what he was going to say because you didn't know. Today, Today, you have everything in front of you. There's so much information, so much more information. I think it makes it more difficult to manage money. And you used to be able, as you said, anticipating. Markets would anticipate a change, and by the time the change comes, the market would go as long as it went in the direction that everyone thought the change should go. Today, I can't find out when they're anticipating the change. Is this sell off due to anticipation or not? And what's going to happen after? I think it's more difficult.
Yeah. And another way to say that is the markets have become more efficient as information is more widely available.
Yeah, that's a
Go
smart
back.
way to say it. I like to do it the way I want to do it.
Okay. Right.
That's a much smarter way to say it.
Yeah, but that is a challenge, right? There's just more eyes on the data. There's more information available to everybody in an instant. And that filters into the markets, and markets, particularly when you're trading, it's a competition. You have to have insight over the average investor. The average investor's intelligence has increased over time. So having insight versus that is more and more difficult. And now you have computers you're competing with and AI, and so it's a tough game for sure.
Well, AI is a real thing, I think, that's coming on. It's just, you see, we have firms that work with us here at AdvisorHub. They're starting to, first we had robo advising, which never really I thought was going to be a problem. I don't know that AI is a problem, but it's just another way of doing research and creating algorithms and things like that. That you can see where you could use that to your advantage. You can also see where it turns into the Terminator, maybe, but at the same time, there's a balance somewhere, right?
That's right. That's right. And through all that, to me, what's pretty surprising is there's three things that I think every portfolio should try to emphasize, and they still don't really do that. I think trying to time markets has become more difficult, as we just discussed. But there's three things that I think are reliably beneficial: maximize diversification, minimize fees, minimize taxes. And those are the things that still hold true through all of this technological innovation and advancement. And still, I'd say probably investors are probably less diversified now than they were 10 years ago, and probably trying to be more active, typically higher fees, less tax efficient. Those are things you can be confident benefit you over time. And that's surprisingly, with all the information, it's still not being, implemented in a wide scale. So to me, that's probably the most surprising thing.
Look, there's investors, right, in the stock market, but there's still a very large group of people and portfolio managers that like to chase something hot or chase an idea. Right?
Yeah.
There's a ton of that going on because, I heard this guy down the street, he had a 10 bagger, and I'm going to do that too.
That's right. That's right.
It's just sort of human nature.
That's right. I mean, humans are hardwired to have biases, and they tend to respond to emotional impulses. And that hasn't changed in 1,000 years, and it probably won't change. We may become smarter, but we're kind of hostage to our emotions. And markets can be extremely emotional. You're dealing with money, right? The FOMO is real. The fear of loss is real. I mean, those haven't changed. It's pretty remarkable.
Look, and I'm in the publishing business. There's two things: fear and greed. That's what you want a story to work.
That's right.
Is it going to scare me, or can I make money?
That's right. Yeah. And one of the golden rules, one of the golden rules of investing is buy low, sell high. Yet almost everybody does the opposite still.
Of course.
It's pretty phenomenal. And that, as an advisor, our job is part analyst and part psychologist. And the psychology part is becoming probably even a bigger part.
So I'm interested because, I've been doing this, for a long time, and I've worked with large advisors, managed them and things like that. And we had just as it is with you all, with top, multi-billion-dollar advisors, there's a level of loneliness at the top that's unnecessary, but it is there. Getting you guys together, you find everyone's in the same pool. So we've got a similar amount of problems. But you get the 9-figure clients together in a room, and they have a similar set of problems, whether it's a second marriage or it's I got a fractional ownership of this plane, but this is a ripoff. I mean, before you know it, everybody has very similar situations that how they've gotten here and outlooks on life. And by the way, particularly if they're your clients, because again, you've attracted them for some reason. So there's a similarity. Do you ever get them together?
I used to do that more, pre-COVID, and maybe have one kind of client event a year. Haven't done it since. I do some Zoom meetings, but that's not as effective. But it's definitely something we should be doing more often.
Yeah, I just think you find the interactions are interesting and the idea share and stuff like that. And are you totally bonds and equities, or do you guys do other stuff too, real estate investment or anything like that, or things that are outside?
Yeah, I mean, our focus is diversification, as I mentioned. So we do equities, fixed income, all sorts of alternatives: private credit, private equity, private real estate. We look for things that are uncorrelated. We try to focus on things that I call structural alpha, where we create structures that generate excess returns that is more reliable than trying to time markets. And in general, we tend to own less equities than most investors, because we try to find things that are equity-like in their returns but are diverse. And I think that's how you build a more diversified portfolio. That's really what we emphasize.
Yeah, I think that makes a ton of sense. Well, believe it or not, we've been talking for 20 minutes or so. So I think it's very interesting. I love the story, and I appreciate where you are today and how much work it took to get there. So congratulations on that.
I appreciate that. I feel like I'm just getting started.
Yeah, I would agree. Well, look, we can always do this again, Alex. You don't have to be a stranger. We're going to see you at, maybe you could continue this talk at one of our events, which would be nice. I'm sure the guys would love to hear
Yeah,
about.
that sounds great.
All right, great.
I
Thanks,
appreciate it,
Alex.
Tony.
You
Thank
got
you.
it.